So when it comes to saving for retirement, there are literally 100 options out there. Most people know about the 401k or the IRA, and both come in numerous flavors and variations. All of these are referred to as defined contribution plans, and with these the employer, employee, or both make contributions on a regular basis and the money is invested. There are no guarantees, and the burden to save and invest sits squarely with the worker. There is also something called a defined benefit plan, which is known more commonly as a pension. It's essentially an employer-sponsored benefit for employees with a payment awarded after retirement and typically based on the employee's salary and length of service. The money is guaranteed and the burden to save and invest lies with the employer. Over the last 50 years, pensions have become less and less common in the private sector, with only about 15% of private employers still offering them. It is the complete opposite in the government, with around 85% of workers covered by a pension, but that is still just a small fraction of all workers nationwide, as the public sector in the US accounts for only about 13% of the workforce. There is, however, an interesting third type of retirement plan. It's a hybrid of defined benefit and defined contribution, and it's called a cash balance plan, or CBP. It's not for everyone, and in fact, it's mostly high earners that gravitate toward it, but it does offer a lot of unique options to both the employee and the employer. In this video, I'll cover all the basics of a CBP, and if it's an option for you as an employee or as a business owner, you'll know what it's all about. Hey, if you're new to the channel, my name is Elliot. I'm a long-time investor and financial advisor. I create helpful videos just like this one to make you smarter about your money, so be sure to like and hit the subscribe button to stay on top of all the new releases. And now, back to the video. Okay, so how does a CBP work? Well, much like a 401k, it is an individual retirement account and administered as such. However, it's also much like a regular pension with a set percentage of your yearly salary contributed and guaranteed by the employer. Here's where things really differ, however. Unlike a pension or a 401k, the CBP is governed by the unique cash balance formula. It states that your total annual retirement benefit is made up of two factors, which include a pay credit and an interest credit, as seen right here. The first factor then is your annual salary multiplied by the pay credit, which is just a percentage of that salary. So if the employee makes $100,000 per year and the pay credit is 5%, then they get $5,000. The second factor is the account balance multiplied by the interest credit rate. That is just a growth percentage for investments set by the employer, and let's say it's 8%. This number can be fixed or variable, and if it's variable, it can be indexed to the rate of return from an asset, such as a 5-year treasury note or an index fund. Okay, so finally, put the two factors together and you have an annual retirement benefit. As I mentioned earlier, the cash balance plan formula is quite a bit different from a regular pension and is very different from a 401k. It's also more complex, requiring more oversight from money managers to make it work, and indeed the cost of implementing a CBP is significantly higher than most other types of retirement plans. However, there are extensive tax benefits, and CBPs allow for much higher contribution limits, which in turn can attract highly paid top-tier talent to a company, and high net worth individuals do often take advantage of these to reduce their overall tax liability. These plans, despite their costs, also hold many advantages for the companies that offer them, and in recent years, more and more employers have shifted to cash balance plans from traditional pension plans because the strong tax advantages of CBPs reduce overall pension obligations. There are approximately 22,000 cash balance plans in the US right now, with 9 million participants and $1.2 trillion in assets. A very important feature of the CBP is that because it is a type of pension, it is guaranteed by the Pension Benefit Guaranty Corporation, or the PBGC. That means if the corporation fails for some reason, the PBGC takes over management of the trust and makes sure the account holders are made whole. There are a few other unique features of the CBP that are worth mentioning. First off, CBPs are structured in a way that allows employers to contribute more as the age of the employee rises. Thus, these plans allow for catch-up contributions for employees who take many years to reach their high-earning years, such as the case with senior executives. This is somewhat similar to the 401k, allowing catch-up contributions after age 50, but at an even larger scale. A second unique feature is that disbursements from cash balance plans, once the beneficiary retires, can be in the form of not only lump sum but also lifetime annuity payments. If the beneficiary decides to receive a lump sum distribution, they may have the option to roll it over into individual retirement accounts or another employer's plan if the cash balance plan accepts rollovers. So there are a lot of ways to get a disbursement. Finally, with a cash balance plan, even if you're the youngest employee at the company, you get the same benefit as the oldest employee. employees. Instead of using the highest few years of compensation, a cash balance plan averages all the years you're with the company, including the ones where you earn the lowest wage. In other words, with a CBP, your distributions typically increase as your compensation increases. With all these benefits, of course, comes some downsides as well. I already mentioned the higher cost of setting up and administering a CBP, but there are a few other cons to keep in mind. Distributions are taxable, and as far as adding money into the plan, you're not allowed to do this. Only your employer, but you are free to have a 401k in addition to a CBP, which you can contribute to. Finally, as with any retirement plan, you can't touch the money until age 59 and a half, as there will be taxes and penalties assessed. So is the cash balance plan a better version of a pension and superior to a 401k? In some ways it certainly is, but the real answer is it depends. For certain businesses and high-earning key employees, this may be the way to go, but it's not cheap, and for many businesses, a regular 401k is all they need, or perhaps a regular pension if they still offer those. Okay, hope you learned something new and useful. If you did, drop a like and be sure to subscribe to the channel, and I will see you all in the next video.